You ever look at a price chart and you're thinking, okay, this is definitely going up, but then you click a button, change the view, and suddenly it looks like it's crashing? Yeah, it's a super common thing that trips up a lot of traders. It's this paradox that can make the market feel totally random. So today, we're going to clear all that up. Let's dive in. So the whole issue really starts with what looks like a massive contradiction in how the market moves. I mean, on one hand, you see this crystal clear direction, and on the other, you're seeing the complete opposite. All right, just look at this right here. On the left, you've got a chart that's just screaming uptrend. You see the higher highs, the higher lows. It's a textbook upward move. But then you glance over to the right, same asset, same time period, and whoa, it's a sharp nosedive. It just goes to show you that depending on how you're looking, the market can seem to be doing two completely different things at the exact same time. And that brings us to the big question, right? How on earth is this possible? How can a single stock or coin be bullish and bearish at the same time? It feels like it breaks the laws of physics or something. But the answer, you'll see, is actually pretty simple. And it's going to completely change how you look at charts from now on. The solution to this whole puzzle, it's not some secret indicator or a complicated trading strategy. It all comes down to understanding one fundamental concept, that is, quite literally, a new lens for seeing the market, the time frame. So what exactly is a time frame? Well, it's really simple. It's just the period of time that each one of those little candlesticks on your chart represents. Every single candle is a neat little package of all the price action, the open, the high, the low, and the close for that specific chunk of time. Could be a minute, could be an hour, could be a whole week. You know, the best way to get this is to think of it like a camera lens. It's a perfect analogy. The higher time frames, like your daily or weekly charts, that's like using a wide-angle lens. You're zooming way out to see the entire landscape, the big picture trend. And the lower time frames, your 1 minute or 5 minute charts, that's your zoom lens. You're getting right in there to see every little detail, all the minute to minute noise. Okay, so now that we have this idea of different lenses, let's build on that. Because when we start to categorize these lenses, we can see how different types of traders are mapping out the exact same market in totally different ways. And here's what's so fascinating. A trader's personal style is directly tied to the time frame they use. I mean, long-term investors, they practically live on the daily and weekly charts, trying to catch those huge multi-month trends. Day traders are usually somewhere in the middle, on the 1 hour or 4 hour charts. And then you have scalpers who are in and out of trades in minutes or even seconds. They're glued to those short-term charts. See, there's no best one. It's all about matching your lens to your game plan. So we get that there are different time frames, but that still leaves a pretty big question, doesn't it? Why do they seem to tell such different stories about the market? Well, the reason is this really cool concept that you see everywhere in nature, from coastlines to snowflakes. And the answer is, markets are fractal. This is such a mind-blowing idea. It basically means that the same patterns, which are really just patterns of human emotion and behavior, they repeat themselves on every single level. That huge uptrend you see on a weekly chart, it's made up of a bunch of smaller uptrends and pullbacks on the daily chart. And that daily chart is made up of even smaller trends on the hourly chart. It's the same structure over and over again, just zoomed in or out. Okay, so knowing the market is fractal is a really cool insight, but how do we actually use that information to make better decisions? Well, this is where professional traders get their edge, by combining these high-level and low-level views. Here's the key. Successful traders almost never, ever just use one time frame. I mean, that would be like trying to drive a car by only looking 5 feet in front of the hood. It's just not going to work. Instead, they use what's called multi-time frame analysis to build this complete 3D picture of what the market is really up to. And the method they use is a pretty straightforward 3-step process. First, step 1, they start high. They look at something like a daily chart to figure out the overall trend. You can think of this as checking which way the river is flowing. Then, for step 2, they zoom into a medium time frame, like the 1 hour, to find a good spot to get in, to join that flow. And finally, for step 3, they zoom in one last time to a low time frame to really nail their entry and exit points with precision. This way, they're always trading with the main current of the market, not fighting against it. That's a mistake that gets so many new traders into trouble. So now we can take everything we've talked about, bring it all back together, and finally make sense of that paradox we started with. Remember that crazy contradiction from the beginning where the market was going up and down at the same time? Well, it turns out it was never a contradiction at all. It was just a matter of perspective. The daily chart was showing us the forest, the big, dominant bull market. But the 15-minute chart, that was showing us the trees, a small, temporary, bearish pullback inside that much larger uptrend. You see, both were true. The market really wasn't a long-term uptrend and a short-term downtrend at the exact same moment. And this all leads us to the final, and I think the most important takeaway from this whole thing, the incredible power of perspective. So look, the point of all this isn't to get into some debate about whether the 5-minute chart is better than the daily chart. It's about realizing that you have a choice. It's about consciously picking the right lens for the job you're trying to do. Are you trying to see the big picture, or are you looking for the perfect moment to act? Each one needs a different lens. And this is the real magic of using multiple time frames. All that stuff that looks like random noise and chaos on a low time frame, it can suddenly snap into a clear, understandable pattern when you just zoom out. You're literally transforming chaos into order. So once you understand that you can change your perspective, that you can zoom in and out whenever you want, you're not just passively watching the market anymore. You're an active participant. You get to decide which part of the market story you want to pay attention to. So the only question left to ask is, what story will you choose to see?